Hello, my name is Tony Smith. I'm the Chief Internal Accountant for Expresso. My department oversees compliance with all FASB and GAAP guidelines in creating our financial statements. These financial statements appear in the annual report. To put the statements together, we use the data made available from the general ledger system. Now, as you know, the principal statements are the balance sheet, the income statement, and the statement of cash flows, as well as any financial notes. Here's the Expresso annual report ending in December 1994. The annual report gives a picture of the financing and investing status of the firm. Right off the mark, a potential investor can tell a lot from a balance sheet. For example, Expresso's liquid or current assets represent 50% of total assets. Current liabilities represent only 25% of total liabilities. Now, this means that Expresso is in excellent shape to meet its debts and operating expenses. Next is the income statement, which gives a picture of our operating performance. As you can see, expenses absorb most of our revenues. According to GAAP guidelines, we use the accrual accounting method, so wherever possible, these expenses are directly matched to revenues. Then there's the statement of cash flows. Cash flow from operating income was used to support operating activities. The net result was a positive cash flow statement.
The balance sheet shows the balance of equality between investing and financing in a given point in time. Investing yields resources which the firm can use for future benefit. Financing provides the source for acquiring those resources. Resources are assets the firm can use for future benefit. Equities are interests or claims on those assets that arrive from financing. Equities are comprised of liabilities, creditors' claims on assets, and owners' claims, known as owner's equity on assets. Therefore, assets equal liabilities plus owner's equity. This fundamental accounting equation applies to all businesses, regardless of industry or form of organization, and must hold at any point in time. Here is a listing of typical categories which you would find on the balance sheet of a company. Here are the 1993 and 1994 comparative balance sheets for Star Enterprises as of December 31st, 1994. Use the magnifying glass on the left to enlarge the balance sheet so that you may study it. Would you expect the Star Enterprises June 30th, 1994 balance sheet to be the same as either its December 31st, 1993 or its December 1994 balance sheet? You are correct. Information reported on the balance sheet reflects conditions as of the date of the balance sheet. With the passage of time and the occurrence of events, the amounts on the balance sheet are likely to change.
As you know, the balance sheet presents a picture of the financing and investing status of a firm at a specific moment in time. But a balance sheet offers a great deal more information. What is an asset?
Not completely. Assets are resources that a company has already acquired the rights to use, and for which the company can quantifiably measure future benefit.
Each of these radios offers a different news story about Star Enterprises. Please listen to each carefully.
The CEO of Star Enterprises has an excellent reputation. He has successfully led the company through some difficult times. In fact, some of the shareholders have publicly called him the company's strongest asset. Is the CEO an asset on Star's balance sheet?
You are correct.
Star Enterprises, in an unprecedented action, has purchased from the Hungarian government patent to a new manufacturing technique. When questioned, spokespeople for Star said they could not give exact estimates on the value of the patent, but strongly believed that it would provide significant savings during the manufacturing process. Questioned further, Star spokespeople would not comment about plans to open a plant in Eastern Europe. Is the patent an asset on Star's balance sheet?
You are correct.
ACM Corporation announced the closing of an important deal with one of its major suppliers, Star Enterprises. The contract will bring approximately $20 million in revenue to Star over the next 12 months. Is the contract an asset on Star's balance sheet? Correct. It is not an asset on the Star's balance sheet. It is a wholly executory contract. Neither party has performed. Star has a right to future revenues only if Star supplies ACM in the future. We must wait until Star supplies specific goods to ACM to recognize an asset.
To meet the high demands placed on it by the ACM contract, Star has announced the signing of a major contract with IBM to upgrade computers. The contract was signed last week, and over 20,586 processors will be delivered beginning next week. Are the computers an asset on Star's balance sheet today? Correct. This might be a very significant event for Star, but the computers do not belong to Star until next week. Once IBM delivers them to Star, they are Star's assets, and Star has a liability to pay IBM.
Now that you know what an asset is, let's move on to how an asset is valued on the balance sheet. There are several methods of asset valuation. Acquisition or historical cost method. The asset is assigned a value equal to what was paid for it when it was acquired, regardless of how long ago that was. Current replacement cost method. The asset is valued at what it would cost to replace it today. Current net realizable value method. The asset is valued at the estimated sales price less selling expenses that the firm would receive if the asset were sold today?
By definition, an asset is expected to provide the company with measurable future benefit. The estimated future cash value represents the asset's value. However, $1 to be received in the future is worth less than $1 today. Therefore, these cash flows must be discounted to what they would be worth today.
Monetary assets, those representing claims to future payments of cash, are valued at their net present value. Examples of monetary assets include certificates of deposit and accounts receivables. Non-monetary assets, such as inventory, land, buildings, and patents at their acquisition or historical cost.
A company purchased an apartment building complex for investment purposes in 1979. The cost in 1979 was $2.5 million. If the company were to rebuild the complex today, the replacement cost would be $9.6 million. Based upon estimates of future rental receipts less operating expenses, the building has a net present value of $12.2 million. However, a realtor claims that she could sell the building for $14.4 million. Question: which value would you and your insurance company most likely use for a fire insurance policy?
You are correct.
Suppose that a similar building across the street was put on the market today. Your company is interested in purchasing the building. Which valuation method would you use to determine what you would pay for the building and why?
Right answer. The present value of future benefits is often a decision criterion when purchasing non-monetary assets.
You may be wondering why non-monetary assets are valued at their acquisition cost. GAAP justifies this with 3 accounting principles. Click on each for a further explanation.
Going concern. In the absence of evidence to the contrary, a company is assumed to continue in business indefinitely. Companies filing for bankruptcy or experiencing severe financial difficulties are not going concerns.
Objectivity. Internal accountants, as well as external independent auditors, can agree on the acquisition cost as it is easily documented by a receipt, an invoice, or closing statement, for example.
Conservatism. The accounting community generally agrees that more conservative valuation is in the interest of creditors and investors. That is, all else being equal, a lower value for assets, a higher value for liabilities, and a lower shareholders' equity is conservative.
Now suppose that your company were to prepare financial statements in accordance with GAAP. Your company has been doing well and the future appears bright. At what value would the building appear on your balance sheet, ignoring depreciation, and why?
You are correct.
The use of the acquisition cost for non-monetary assets is supported by the objectivity, going concern, and conservatism principles.
Many companies prepare classified balance sheets, in which assets and liabilities are classified as current and non-current. This classification depends upon the length of the company's operating cycle. An operating cycle is the normal or average length of time that it takes a company, starting with cash, to invest the cash in a product or service, sell the product or service, and collect from the customer and get cash back.
Current assets are assets which the firm will either use for operating expenses or realize as cash within the next year or operating cycle, whichever is longer.
Investments are usually securities issued by other firms, and intended to be held beyond the next year or operating cycle, whichever is longer.
Property, plant, and equipment are assets which the firm uses over a period of years and which are not resold. Examples of intangible assets are copyrights, goodwill, patents, and trademarks. As you may already know, accounting does not recognize a firm's intangible assets on the balance sheet because their value is too difficult to measure. However, intangible assets which are acquired in exchange can be valued on the balance sheet at their acquisition cost.
As you know, the balance sheet gives a picture of the financing and investing status of a firm at a specific moment in time. The right side of the balance sheet is comprised of liabilities and shareholders' equity, or the financing status of the firm. What is a liability? Please click on your choice.
Right. A liability is an obligation arising from a past transaction that requires the firm to transfer assets, usually cash, or to provide the promised goods or services.
What is a liability? Most liabilities are satisfied by paying cash, and therefore are monetary. Depending upon when the cash is to be paid, these liabilities are shown on the balance sheet at either the amount of cash to be paid out or the present value of the future cash payments. Some liabilities are satisfied by providing goods or services to customers and are therefore non-monetary. These arise because the firm has already been paid for the goods and services and has an unsatisfied obligation. On the balance sheet, these liabilities are valued at the amount of cash previously received.
Current liabilities are obligations to be satisfied by the use of current assets. Thus, the firm's operating cycle controls the definition of current liabilities as well as current assets. Because obligations to suppliers, employees, and government arise during the operating cycle, they are current liabilities.
Long-term debts extend beyond the next year or operating cycle, whichever is longer. Because most firms have an operating cycle which is less than 1 year, it is customary to view current liabilities as those coming due in less than a year and long-term debt beyond 1 year. Examples of long-term debt include bonds, mortgages, and certain types of leases. Other long-term liabilities have due dates more than 1 year after the date of the balance sheet, but are not typical of long-term debt. Examples are deferred income taxes and pension obligations. You are about to listen to a series of comments by independent auditors about Star Enterprises. In response to each, please answer the questions asked.
Beginning in January of this year, Star began a major public relations campaign. The public relations agency invoiced $50,000 last month. Is this a liability? Yes, you are correct. By receiving the services, Star is obligated to pay the invoices. Beginning in January of this year, Star began a major public relations campaign. The public relations agency invoiced $50,000 last month.
Is this a current liability or long-term debt?
You are correct. Star Enterprises' balance sheet shows an amount of deferred income taxes. Is this listed as a long-term debt or under other long-term liabilities? You are correct.
Star Enterprises receives $20 million from a customer for the next delivery of products and services in Eastern Europe over the next 6 months. Is this a monetary or non-monetary liability? No, this is a non-monetary liability representing goods and services.
As you already know, total equities are comprised of liabilities plus shareholders' equity. Together, they equal total equity.
Shareholders' equity consists of contributed capital and retained earnings. Retained earnings are earnings which are left over after dividends have been paid.
You are correct. Creditors do not receive dividends. They receive repayment at a specified date with interest.